Drake keeps seeing headlines about billionaires who are worth tens of billions of dollars, but somehow report almost no taxable income. It isn't a loophole nobody's looked at, and it isn't illegal. It's a real, well-documented strategy. With a name, buy, borrow, die, Daniel's going to walk through exactly how it works and why it's genuinely not something most people can or should copy. 3 steps, each one legal, each one with real mechanics and real risk underneath the headline. Before we get into it, if breaking down real tax strategy like this is useful, hit subscribe, new video every week. It's also worth framing the timescale honestly up front. This isn't a quick maneuver executed in a single tax year. It typically plays out over decades, years of asset appreciation before there's meaningful value to borrow against, followed by however many years of borrowing the person lives, followed by whenever death actually occurs. None of the tax benefits described in this video happen instantly. They're the result of a long, specific sequence. Step 1. Buy. Acquire assets that appreciate over time, concentrated stock positions, real estate, a business stake, and simply hold them rather than selling. Step 2. Borrow. Instead of selling appreciated assets to fund spending, borrow against them using the assets themselves as collateral. Step 3. Die. At death, heirs inherit the assets at their value on the date of death, not the original purchase price, erasing the unrealized capital gain entirely under current law. The core of the entire strategy is one specific rule. Loan proceeds are not taxable income. Selling a stock that's gone up in value triggers capital gains tax. Borrowing against that same stock, using it as collateral, does not, because a loan has to be repaid. So the tax code doesn't treat it as income in the first place. Picture someone holding stock worth $1 million that they originally bought for $200,000. Selling all of it realizes an $800,000 capital gain, taxed at 15 or 20% federally depending on income, potentially plus the net investment income tax. More on that shortly. Borrowing $1 million against the same stock instead means zero tax is triggered on that transaction, and the full amount is available to spend, because it's debt, not a taxable event. That borrowed money can be used for essentially anything: a home purchase, funding a business, ordinary living expenses, all without ever triggering the capital gains tax that a sale would have caused. This is the entire financial logic of the strategy. Access the value of appreciated assets without the tax event of actually disposing of them. The borrowing mechanism is usually a securities-based line of credit, or SBLOC, offered by major brokerages, pledging an investment portfolio as collateral in exchange for a credit line. Typically worth somewhere between 50 and 90% of the pledged portfolio's value, depending on the broker and the type of assets held. As of mid-2026, SBLOC interest rates run roughly 5.85 to 7.95%, calculated as the SOFR benchmark rate, currently around 4.30%, plus a broker-specific spread of about 1.30 to 3.65%, depending on the lender and the size of the credit line. These are floating rates that reset monthly, meaning the interest cost rises and falls automatically as SOFR itself moves. It's worth distinguishing this from a regular margin loan, since the two get confused. A standard margin loan is tied directly to a brokerage trading account and is typically used to buy more securities, subject to Federal Reserve Regulation T limits, and can be called with very little notice if the account's value drops. And SBLOC is usually a separate credit line specifically for outside spending, a house, a business, living costs, not for buying more stock, though it carries similar collateral and maintenance call risk underneath. There's a concentration risk specific to this strategy that's easy to overlook. The same asset backing the loan is often the person's primary source of net worth, a founder borrowing against their own company's stock, for example. If that specific company's stock declines, both the collateral value and the person's overall wealth drop together at the exact moment a maintenance call is most likely to hit. Diversified collateral spreads this risk out. A single concentrated position doesn't. The final step is where the strategy earns its name. Under a specific tax rule, Internal Revenue Code Section 1014, an heir's cost basis in an inherited asset gets reset to the asset's fair market value on the date of death, not what the original owner paid for it. If the heir sells immediately at that same value, there's no capital gain to tax at all, because, on paper, no gain ever happened from the heir's perspective. This step-up doesn't apply everywhere, though it does not apply to IRAs, 401ks, or other tax-deferred retirement accounts. Those get taxed as ordinary income on withdrawal regardless. It also generally does not apply to assets already transferred into an irrevocable trust during the original owner's lifetime. The step-up specifically covers assets still directly owned, like brokerage-held stock or real estate, at the moment of death. It's also worth knowing this rule doesn't sit unchallenged. Step-up basis at death, sometimes nicknamed the angel of death loophole in tax policy discussions, has repeatedly been the subject of federal legislative proposals aimed at limiting or eliminating it. None have passed as of 2026, but it remains a live policy debate, meaning the rule described in this video, while accurate under current law, isn't guaranteed to remain unchanged indefinitely. The capital gains rates this strategy avoids aren't small at high income levels. For 2025 and 2026, long-term capital gains are taxed at 0, 15, or 20% federally depending on income. But above $200,000 of income for a single filer, or $250,000 for a married couple filing jointly, an additional 3.8% net investment income tax stacks on top. Combined, that produces effective top rates of 18.8% in the 15% bracket and 23.8% in the 20% bracket for someone with a large, concentrated, highly appreciated position. The exact profile of a startup founder or early employee sitting on company stock, a full sale could trigger a tax bill in the tens or hundreds of millions of dollars. That's the scale at which avoid the sale entirely becomes worth the complexity and cost of borrowing instead. It's worth being clear about who doesn't need any of this. A large share of taxpayers already fall within the 0% long-term capital gains bracket simply based on their regular income. For 2025, that's taxable income up to $48,350 for a single filer. For someone in that position, selling an appreciated investment outright already costs nothing in federal capital gains tax. There's no borrowing complexity or estate planning maneuver required to get a better outcome, because the better outcome already exists by default. All the mechanics described in this section, SBLOCs, maintenance calls, floating rates, only start to matter once income and asset values rise well past that starting point. This strategy is not free money, and it is not risk-free. If the pledged portfolio's value drops significantly, the lender can issue a maintenance call, demanding additional collateral or immediate partial repayment, and if that can't be met, the broker can force sell the pledged shares automatically at the worst possible moment to cover the shortfall. This is functionally similar to a margin call, and it has wiped out concentrated stock positions during real market downturns. The floating rate is a second real risk. Since SBLOC rates reset monthly with SOFR, a borrower who set up a line of credit when rates were low can see their monthly interest cost rise substantially if SOFR climbs, with no ability to lock in the original rate. And the debt itself doesn't disappear. It typically has to be repaid or refinanced within the borrower's lifetime, or it becomes an obligation the estate has to settle. A related but distinct planning tool worth a brief mention, the annual gift tax exclusion, currently $19,000 per recipient for 2026, lets anyone give that amount to any individual each year with no gift tax return required at all. A married couple can effectively give $38,000 per recipient by splitting the gift. This is a separate strategy from buy, borrow, die, used to move wealth to heirs gradually during life rather than waiting for death. But it's often combined with it in real estate planning. Real estate has its own separate, related tool too. A 1031 exchange lets an investor sell one investment property and roll the proceeds into another similar property without triggering capital gains tax at that time. Different mechanics than borrowing against stock, but the same underlying goal of deferring a taxable sale for as long as possible, often until death. When step-up basis takes over again, this entire approach only functions safely at a specific scale. enough concentrated wealth that borrowing a modest percentage of it comfortably covers spending needs, with enough of a buffer that a market downturn doesn't trigger a forced sale spiral. For most households, the numbers simply don't work that way. A retirement account in the tens or low hundreds of thousands of dollars doesn't generate enough safe borrowing capacity to replace an income, and the risk of a maintenance call would be disproportionate to the benefit. The die step also requires something most people don't have the luxury of, never actually needing to realize the gain during their own lifetime. For the vast majority of savers, actually using retirement savings during retirement, which usually does mean eventually selling assets and paying tax on them, is simply the more realistic and appropriate plan. One more layer worth naming: the $15 million federal exemption isn't the only exemption that can apply. About a dozen states impose their own estate or inheritance tax, often with exemption thresholds far lower than the federal number, in some cases as low as $1 to $2 million. Someone's total tax exposure at death depends on both the federal rule and whichever state's rules apply, which is exactly the kind of detail a real estate attorney sorts out rather than a general explainer. Drake's instinct here is reasonable. Debt has caused plenty of damage in other videos on this channel, from 21 to 22% credit card APRs to auto loans stretched past 7 years. The difference with SBLOC isn't that debt magically becomes safe. It's that the collateral, the rate, and the purpose are completely different from consumer debt used to cover a shortfall. Debt taken against appreciated assets to avoid a tax event is a fundamentally different risk profile than debt taken because there wasn't enough cash to cover a bill, but it's still debt, with real repayment obligations either way. To be direct, buy, borrow, die is fully legal. It isn't tax evasion, and every piece of it relies on rules written into the tax code, not a loophole being exploited improperly. But it isn't simple either. A separate tax, the federal estate tax, can still apply at death on estates above the exemption amount, $15 million per individual and $30 million per married couple in 2026, at a 40% rate on the excess, meaning very large estates can still owe substantial tax even with the income tax side benefits of step-up basis intact. And that estate tax bill is due in cash within months of death, regardless of how illiquid the underlying assets happen to be at the time. It's worth being precise about the vocabulary here too, since the two get mixed up constantly. Tax avoidance means legally structuring finances to reduce a tax bill using rules that actually exist in the code. Exactly what buy, borrow, die does. Tax evasion means illegally hiding income or falsifying information to the ears. Nothing described in this video crosses into evasion. Every mechanic here is disclosed, reported, and built entirely on published tax law. The strategy works precisely because it follows the rules exactly as written, not because it hides anything from anyone. Anyone considering any part of this, pledging assets, opening an SBLOC, structuring an estate around step-up basis, gifting under the annual exclusion, or running a 1031 exchange, needs an actual tax attorney and financial advisor involved, not a video, because the mechanics interact with someone's specific total financial picture in ways that are easy to get wrong. For nearly everyone watching, the realistic version of building wealth still looks like the strategies covered elsewhere on this channel, contributing enough to capture a full 401k match, maxing out an IRA where possible, and building toward a dividend or index fund position over decades. Buy, borrow, die is a real strategy that exists at the very top of the wealth distribution. Understanding how it works explains a confusing headline, but it isn't a substitute for, or a shortcut past, the slower, more accessible path that actually applies to most people's situation. Buy, borrow, die is real and legal. Buy appreciating assets, borrow against them tax-free instead of selling, and let step-up basis erase the unrealized gain at death. SBLOC rates currently run 5.85 to 7, 95%, floating monthly with SOFR. Step-up basis doesn't cover retirement accounts or lifetime trust transfers, and the federal estate tax can still apply above the $15 million exemption. It only works safely at real scale, with real risk of forced sales if asset values drop, not a strategy for a typical retirement account. This video is for educational purposes only and is not personalized financial advice. If this made a confusing headline finally make sense, subscribe, new video every week. Next up, what actually happens the day you invest your very first